Well, welcome everyone back to our monthly IMAP lunch. Great to have a bunch of you here again and some new faces in the room. Always fun. And we have a number of people online as well. We are recording this and we'll post the presentation part online most likely after the session, but not the Q&A at the end. Today, I'm happy to welcome a guest from outside the university to come present to us an industry perspective on things going on in this area. We have Lukasz Pomorski from Acadia. Welcome.
Thank you kindly. Thank you for the invitation, and it is a pleasure to be here. And I do an intro. I will say that I'll give you my sort of industry perspective, but I happen to have sort of my foot in a couple of different worlds. So the way that this talk got organized, Marcel, who I have known for well over the decade, before he was great, and when I still had some hair, we were colleagues together at Toronto, and he found out that I have a book on ESG investing and said, fantastic, why don't you talk about some of the topics? So fine, I would love to, but I'll tell you that I wrote that book because first of all the questions are really interesting. So we'll talk about some of them. We want more than just scratch the surface basically. But I also say that very often these questions get answers that are extremely one-sided. People don't appreciate kind of the full picture. People don't appreciate the trade-offs which abound in this space. To make it worse, there's a lot of muddled thinking, not less so nowadays than, let's say 5 years ago, but very often you actually get a question and then you hear some answers from the industry, from the media and such, and you just cringe because maybe they really miss the point, where they sometimes get the exact wrong answer to a question. So eventually I thought that I didn't even think about the book initially, but at some point 5 years ago or so, Yale approached me, can I just build a course, master level course on ESG investing? So I did this. I eventually moved the course to Columbia, but I have thought about these issues. I had already all the material, and eventually writing the book was kind of a sort of obvious next step. Now, to your point about the kind of industry perspective, so yes, I over my sort of career at AQR, I was working on a lot of these topics. Eventually, I was the head of ESG research at Acadian. I'm on the portfolio management team. We do have very demanding clients who require a lot in terms of sustainability. I do work with them. I do oversee their portfolios and such. So I will offer this, but I also have that sort of academic affiliation. I've published on ESG in academic journals. I also am I think fairly vocal part of a conference circuit, the alphabet soup of the organizations. So I serve on some committees at the UNPRI. I used to serve at IGCC and so on. So I do hope that my comments today, but also what I put in the book, reflect more than just one important sort of side of a conversation. But I'm trying to give you more of a well-rounded perspective, and where the answers lie may differ for different viewpoints. Okay. So to start with, let me just tell you about some of the misconceptions that I think people have in this space. And I will say that I only have about half an hour, so we'll really focus, on the bolded part in the middle, on impact, on how to drive change, how to influence, let's say, corporate behavior through your financial portfolio. So that's our topic for today. But I will say that this is just one really important, but one section of what people should think about in this space. There's this basic question, maybe the most frequently asked question in this space is, does ESG, does sustainability help you or hurt you, for example? That's something that we may talk about in Q&A. I have some strong views there, but I will argue that this is maybe the most obvious question to start with. There's so much controversy about ESG data, thinking about data from third-party providers. People underappreciate what the data is actually used for in practice. People underappreciate the variability between different providers. People say sometimes that, but ESG data is all over the place. It doesn't correlate very well. I would argue that this is exactly what you should expect purely from the industrial organization perspective. If you take the IO kind of perspective and view providers of ESG data as profit maximizing firms, I think you should expect that they will give you products that are not identical and such. And again, I'll do much just teasing you with this right now. If you're interested, we can talk more about it after my prepared comments on impact. I'll also say that through today, and certainly a few years ago, people thought about sustainability primarily in the context of traditional strategies, your stock portfolio, your bond portfolio. There is a lot of interesting insights I think that we could talk about in the context of sustainability in alternatives. What happens when you can short, for example? What happens in illiquids, in private estate, in real estate, in private equity, in real estate? What happens in commodity markets, for example? How to think about carbon allowances, not only as a potential investment asset, but also an asset through which you may have some impact and so on. So again, I'm teasing you with a couple of topics here. I won't talk about them. I will focus on impact today, but if you're interested, I'm more than happy to continue the conversation on later today or on another occasion. Now, let's start this conversation about impact, just acknowledging that, again, I will define that impact as changing your stakeholders. I'll focus on corporates. There's more than corporates out there, but changing the firms you invest in through your financial portfolio. And I really emphasize the second part, through your portfolio decisions. And the reason is that there's multiple other channels of impact that I won't even talk about today, that are in principle open to just about anybody. You think about sort of influencing broader society. If you think about talking to your legislators and so on, you don't need to be a portfolio manager to do that. You don't need to change your portfolio to increase your chance of achieving your desired outcomes. So I won't even talk about this. I'll just talk strictly about what you can do through your portfolio decisions. Now, in this context, let's think about, why should your portfolio companies, why should this company you are a shareholder, a bondholder of, why should they listen to you? It's not an obvious question. I mean, we think that we're important and such, but fine. But through what is the argument why you should expect to have any impact in the first place? It's a little bit of a sobering question. I mean, luckily for all of us, the question has a very strong answer. There are very concrete reasons why companies listen to the shareholders and bondholders. And I would argue that they actually eventually collapse into two categories. It's either control. So this is by far the most obvious one. This is voting. If you're a shareholder and you're holding, a votable security, you have a vote. You can influence some, not all, but some decisions of the company, or at least the makeup of the board, for example, who will in turn influence what the company does. There's, engagement. You can just talk to the company. Why would they listen to you? Again, because you have some control over them. Because if they don't do what you're proposing, you may go back to the voting and potentially vote, have a proxy fight, at the very sort of extreme. Direct management. Why would you have impact as a private equity manager? Well, ultimately you have the ownership of the company, so you can have a very direct say on what the company does and such. If you own a piece of real estate, well, if you own it, you can decide to, for example, retrofit its heating or insulation or whatever else. It's your decision as the owner, right? So that's a very direct one, hopefully very, very obvious channel. Much less understood, I think, and somewhat underappreciated is the second channel of cost of capital. And I realize that I'm kind of probably preaching to the choir, because in academia and business schools, we talk a lot about capital budgeting, cost of capital. I think ultimately the corporates also care about this, but you don't see as much emphasis on cost of capital in the general media. When people talk about influencing companies, when people talk about net zero and so on, they typically don't talk much about cost of capital, which I think is a shame. And I'll actually close this talk with a small case study focusing specifically on net zero investing, and I'll come back to this idea then. But before I do, let's talk a little bit more about control. So suppose that I want to influence the company, and I will do this through voting. Maybe I'll set up some sort of engagement with the portfolio company. Well, how should I go about this? It's not a clear question. Think about it this way. If you're a large institution, if you're a pension fund, you are probably holding votable securities of 5,000, 10,000 stocks around the world. So you have 10,000 companies potentially that you need to worry about, maybe more. Each of these companies may have an annual shareholder meeting and may have 5, 7 more items on the ballot. So in principle, you'll need to do some research, have a view about how to vote 80,000 items in a typical year, let's say. That's a massive undertaking. You need to decide, do you do this in-house? Do you actually devote your own resources as the investor to understand what is being asked of you at those ballots, and you decide how to vote. Do you do this in some collaboration? Maybe you talk to other investors, like-minded investors. Do you delegate this? Do you go to a third-party proxy advisor, for example, and ask for a recommendation? How should I vote for this company for this particular ballot? Similarly, in the context of engagement, how do you figure out? You have 10,000 companies you hold. You probably won't have enough time to engage with every single one of them, and most often you probably won't even know what to engage on. So when you think about this from the very practical side, it's not an easy question. And much more importantly then, the question is, how much difference can you make? So let's talk about this in the context of voting first. It is the most obvious channel. I would argue that, but this is somewhat underappreciated, but really important because it features centrally in our concept of corporate governance. If you're a shareholder, you shouldn't presume to run the day-to-day operations of the company. The whole point here is that you will delegate this to the management. And your most immediate kind of part of corporate governance is going to be the board, who you hopefully nominate, vote for, and so on. And that board in turn oversees the management. Okay, so I would argue that that there's a very clear channel through which you can have impact as a shareholder through voting, when you can just elect people who will align better with your idea about what the company should be doing than maybe the incumbents, for example. And I give you examples of this. It's not super easy actually, but luckily for us, we have a couple of really big sort of case studies. Maybe the most famous of them is one that happened a few years ago. Engine number one. So engine number one was a small sort of activist hedge fund. They managed to get multiple, 100-some really large institutional investors on board, and together they meaningfully changed the board of directors of ExxonMobil. Now, I won't spend too much time right now talking about this. It's a really interesting case. You should think about this, read about this. But ultimately, what I'll talk about is what change this drove in terms of what company did subsequently. Let's talk about engine number one. So this was actually the point that I wanted to make. So what did the company achieve? I mean, it's going to be extremely difficult. My last point here is that causality is going to be very difficult to establish. It's very difficult for me to say, but here's the corporate action that ExxonMobil took because of the new directors that engine number one nominated. Okay, but I would argue it's at least plausible, but at least some of the changes were probably stimulated, if not driven completely by those new directors. The fact that ExxonMobil, set up a new division focusing on renewable energy, for example, that it made, for the first time in our history, sort of some investments in those specific projects. Ultimately, it's going to be. I'm not going to claim causality with much force, but even if you go back to December last year, the decision to appoint a new head of our oil and gas division, not traditionally, as it traditionally happens, using somebody who was an incumbent, somebody who had actual experience there, they actually nominated somebody who's to be the president of GE, which at least to me allows for the speculation on my part, but it's partially driven by the desire to diversify the expertise in that direction. Okay. Now, what engine number one didn't do is they didn't shut down sort of a lot of mines, which seems to be your point. And my point is that you should be very, very conscious about what the board actually does. The board, by law, is supposed to safeguard shareholder value, and the idea that the board would approve or stimulate decisions that may not generate, a positive NPV is probably at odds eventually with the regulation. So I'm not surprised in the least that ExxonMobil, even with this very visible intervention, didn't become a company that everybody would agree is extremely green today. There's vocal sort of investors out there from Arjuna Capital, for example, or Follow This, who were sued by ExxonMobil last year, or maybe 2 years ago, for being overly aggressive in terms of additional shareholder resolutions that they wanted to bring about. But I guess this brings me to my point, that you need to be think about not just kind of pro-climate initiatives that investors are looking for or interested in. You also need to take a broader context. So this is a company that ultimately is in the for-profit business, and the officers of the company, fiduciaries who may be investors in the company, and ultimately the board, are bound by these rules. For better or worse, the regulation is there, and I'm not surprised that the company maybe is not delivering to the point that some stakeholders might have preferred. So that's on the voting side. On the engagement, I'll make kind of similar points. On what is engagement? Engagement is going outside of this voting process and actually directly talking to the portfolio company's management, and usually asking them to do something. It might be as sort of natural as asking for more information. If there's a company that is perhaps implicated in some controversies, as a shareholder, you may actually want to know more about what the company thinks about this. You may want to know more about what responses are planning and so on. It could be sort of as intrusive in some sense, and actually asking the company to undertake or to cease some operations. And again, I would put this in the same context. Could you talk to companies? Can you potentially drive value this way? I think the answer is yes, you can, but you need to be very conscious about what the trade-offs are. And most importantly, to me, the trade-off is precisely what I said with engine number one. It's going to be very difficult to engage on projects that might be a negative NPV for the company. Because then you just destroy shareholder value and you immediately run into trouble. You can do it with your money. Perhaps, I'm not a lawyer, I cannot opine on this, but I do believe that this is a kind of central issue that many fiduciaries need to worry about. And if you stop and think, suppose that you actually build that view, you have a very strong view that the project you propose that the company undertake, suppose that you think it's positive NPV. Well, the difficulty is that usually the company knows a lot more about their business than any other stakeholder. And I'm not saying that it's impossible for a sort of outside party or a shareholder and such to have a better view. It's possible. But I think that the barrier for this is actually really, really high. Because you presume that the company is not optimizing its decisions today. Examples abound. It's certainly possible. But again, I would argue that people often underestimate, how important the burden of proof is to be able to document that if you engage on something, it actually is aligned with the idea of maximizing shareholder value. Which brings me to an extremely kind of important ruling just a couple of months ago. So American Airlines were sued in one of the Texas court districts. The lawsuit alleged that American Airlines violated their fiduciary duty by contracting with BlackRock to run their 401k plan. The idea was that, well, BlackRock might maximize more than just financial outcomes. BlackRock historically had been very vocal about climate and such. This was basically the point of a lawsuit. The judge sided with the plaintiff, so the ruling was that indeed there were some issues there around the treatment of fiduciary duty. And I would argue that this goes back to my earlier point, make sure that what you say and do actually is aligned with this idea of shareholder value maximization, at least to the extent that you're fiduciary, that you represent other people's money. If it's your own money, maybe it's a different question, but first and foremost, we operate within a regulatory framework that will limit what we can do potentially, even if it's otherwise sort of worthwhile for other reasons, for non-financial reasons. Now, one of the things that I mean, we'll see what happens, but at least temporarily, once that ruling was made, if you follow any financial news, there was basically, if not a panic, then at least, as a lot of activity ceased basically for a while until people digested what it actually meant. I believe that many investors, for a while at least, stopped engaging with portfolio companies before this. And to me, I don't want to trivialize this, but to me, this was, in a way, somewhat expected. This is something that I talked about in the book, for example, well before the ruling. You actually need to be very careful about what you engage on and how you tie it or not tie it to firm value. I'm not a pessimist in the sense that, I do expect there will be a lot of engagement and very fruitful engagement on a going forward basis. I would imagine that certainly after this ruling, you will have a much more careful approaches. the one area that I think even today or prior to this was the #1 focus of investors, that will be even more important, is transparency. It's going to be engaging with the portfolio company on if it's climate, and the question would be, well, can you provide me more information about your climate stance, about what you do in that space, rather than sort of proactively telling the company to engage in this project or that project. The nice kind of element here, and this is hopefully something that you will sort of that will resonate with you. There's a lot of evidence from academia, actually, from the accounting researchers, that transparency is helpful. Actually leads to greater shareholder value, to valuations. To put it in maybe somewhat simplistic manner, companies that are more transparent tend to be safer from the point of view of investors. You don't demand as much required return on a going forward basis. That actually leads to a higher fair value once you discount future cash flows at the discount rate. Okay, so I would expect a lot more. We already have by far most engagements in that field. I would expect us to be even more focused on transparency on a going forward basis. Now, let me say a few words also about the cost of capital. I think this is unfortunately really underappreciated, and this was your colleague's question. So are you talking to us about something new? Not to you perhaps, because you teach this. You teach NPV. You teach about capital budgeting. You talk about how to adjust the cost of capital of an underlying company. So it's obvious to you. I think it's equally obvious to the portfolio companies. It's not obvious to many commentators. I'll just show you with some examples in a moment. But just to drive the point, which I know that you know very well, why does it matter? It matters because of this NPV concept, net present value concept I already told you about. Why does it matter, or in what shape? Well, if you wanted to discourage a company from activity, well, it's enough actually to increase the cost of capital of the company. Why? Because with higher cost of capital, fewer projects will have positive NPV. So that means that the company will actually undertake fewer investment projects. Okay, it's kind of a simple idea. I think it makes sense. I think it has an impact in reality. But but it's I actually am quoting these are practitioners, but this is a research paper. But one of a few. It's not the only one that you could give that actually question this. It's like, yeah, the story sounds good, but does this actually move the needle? And the claim is that no, it doesn't. And I take a bit of an issue. I mean, I take the evidence. I would just point to some fairly obvious examples where it does make a difference. So sometimes the same people who tell you that cost of capital doesn't matter are very vocal proponents of green bonds. What are green bonds? These are bonds that are issued earmarked for specific projects that are green, that are climate oriented. Now, why would that matter? Well, it matters if you can get your financing cheaper for this project than for something else. Right? So if there is greenium, as it's usually referred to, there's a difference in the capital cost, basically, that you have for green projects versus ordinary projects, and the company will eventually change the mix of its investment projects. They'll undertake everything else equal, more of a cheaper projects, maybe more climate-oriented, and fewer of the ones that are not climate-oriented. Okay. There's also, evidence. From, even if you go to short selling, I guess short selling, I'm sort of touching on the last element that I told you at the very beginning, but in the context of cost of capital, I would argue that, even something that is as seemingly removed from cost of capital as short selling actually can have a impact. And, maybe there's an issue with that paper as well. I'm not sure, but, I actually think it's a really well done paper that looks at the importance of short selling on the, I would argue, cost of capital, and ultimately on the financial and investment activities of a given company. Okay. Now, in my last couple of minutes, let's bring it all together and talk about net zero portfolios. What is net zero portfolios? It's the idea that we want to build portfolios that are holding those companies that are aligned with net zero transitions, that are aligned with the idea that eventually the economy will decarbonize. Now, the underlying kind of reason why people care about this is, we could talk about climate risks and so on, but I think the #1 reason is that they want to see impact. They want to see investors drive change and push their portfolio companies towards those greener outcomes. Now we can map it back to the two channels Are you going to rely on the control channel? And if you read, pretty much all those kind of media reports, if you actually go to some of the kind of founding documents of that whole initiative, it is extremely heavy on control. And I would argue that whether cost of capital is often forgotten, and I think unnecessarily so, or poignantly so. The reason is that when you actually look at what portfolios look like of those investors who have net zero objectives, I think there's the question: are these investors going to build a portfolio and hold a portfolio company unchanged forever after? The answer is no. Right? But if it were yes, it's no. But if it were yes, then I would argue that yeah, then it's a chance for control to actually arise, because then you are a long-term shareholder of a company. Maybe you vote, maybe you engage with the company, maybe you can steer it towards those outcomes that are aligned with that position. In practice, the number one channel, through which you build the net zero portfolio is changing your portfolio composition. How do you align with net zero? You align with net zero by selling the most emitting companies and leaving only those companies in the portfolio that are already fairly green or very green. Okay? So from the point of view of control, you're basically removing any possibility of control because of a simple fact that the vast majority of emissions are due to a small subset of companies that you don't have in your portfolio by construction. So you don't have a vote. It's going to be very difficult to engage. Again, if you do engage, it's not going to be because you have a financial portfolio. You will engage as somebody who doesn't hold that company. No, not an investor. Can you have an impact though? I think the answer is yes, but it's going to be entirely through the cost of capital channel. How can you influence those companies that are doing the emitting? Well, you're doing this by making the cost of capital higher. When I show you this, well, there's a recent paper that literally just looks at what companies say. You can go to the earnings transcripts and you can just try to figure out, is the company talking about the cost of capital? Sometimes they're asked, sometimes they volunteer. You can actually look at the cost of capital that companies say they use in their capital budgeting and map that to emissions. And the interesting pattern is that, until a few years ago, there was no difference in the cost of capital used for budgeting among the green companies and brown companies. But as per that study, the last few years drove to a meaningful divergence in what numbers the green companies are using versus brown companies. And so I would argue that this is quite consistent with the fact that investors in fact have some impact, but the impact is probably for the cost of capital. The last thing I'll show you here is that you can ask some of the portfolio companies again directly. This is a publicly available survey that the Dallas Fed runs for the energy sector. It's interesting reading, if you don't know about this, including for the last quarter, for example. But in my context, yes, I cherry picked some quotes here. But if you look at or you listen to what the companies actually are saying, they are literally sort of putting the blame for the higher cost of capital on investors. Okay, so to me, there is really good evidence, not just logic and economic theory, but also concrete evidence that cost of capital does play a role. And I would argue that for net zero specifically, in my view, it is a much more important channel than control may be. Now, my very last slide, I'll just close with the book, but I do want to thank you for your attention.